Welcome to Veranda CA. In today's session, we will discuss about BEPS, that is Base Erosion Profit Shifting. This is one of the very critical area in international taxation, but as far as your examination concerned, I suggest you just understand what it is and rather not try to go a lot deeper unless you have an elective paper, that is your international taxation. So, as far as this BEPS is concerned, we will have to go through a background of what made this BEPS probably needed or required in today's world. So, typically it is like the first concept is like the impact of the globalization. That is, in these days for quite some time we could sense that almost every entity is playing role across the country, across the globe. So, there are transactions happening between countries and between locations. So, right. So, this globalization has resulted in global trade, whereby there is a huge growth because of which the market, if you actually look at it, because of this globalization, if you actually see, there is a study which says around 60% of the transactions, 60% of the business transactions are actually within multinational enterprises. So, MNEs, that is your multinational enterprises, plays a major role in today's commercial value. So, when it comes to business, it is all about MNEs these days. So, they, as we said in a study, there is around 60% of contribution of business that is happening with an entity that is categorized as MNE. So, this growth and aggressive, in fact, it is an aggressive growth which has led to establishing subsidiaries or group entities across the globe, or some part of partnership across the globe, has resulted in aggressive planning to see that yes, we do business all around the world, but we make sure that we don't pay much of taxes to the government, which means we keep the profits with ourselves and see that we don't pay to the taxes, that is, we don't pay taxes to the government. So, this results in aggressive planning and almost a huge growth. So, that is what we are talking about as this called as this aggressive planning. And if you actually see, there are situations when we said BEPS, we are talking about base erosion profit shifting. So, it is something like base erosion profit shifting, right. So, that is called BEPS. Now, if you actually see the two words, this is one part and this is another part. So, when you say base erosion, they are saying the base country which is supposed to actually earn tax out of that transaction, the base is getting eroded. Let us say a country is actually doing most of the transactions in India, but they are not having any contributions to this. So, what happens is the base that is supposed to be created in India is getting eroded. So, that is concept of base erosion. When you say profit shifting, let us say I have a jurisdiction like USA where probably the tax rates are much lower than what it is in India. So, as a group, my tendency would be to shift profits from India to USA so that I pay lower taxes. We saw that in transfer pricing itself. So, something like where you prefer shifting profits from the higher tax jurisdiction to a lower tax jurisdiction. So, this is what is meant by profit shifting. So, because of this globalization and because of these aggressive plannings, there is a situation that where your base gets eroded and profits get shifted. So, this is the very reason why there is a requirement that there is something of this kind, probably something like an international guideline is required to stop this. So, there are so many adverse effects of this BEPS, right, that is because of base getting eroded and profit being shifted. We saw that earlier in the requirement of treaties itself, like your double taxation or your shifting of profits and all these things is an adverse effect to the globalization market. So, there is a requirement which will negate the impact of this BEPS, that it will not let the base get eroded or it will not let the profits get shifted. So, that is an thing. So, there is, because of this, there is a need for international collaboration, which means because this is not based on one country, right, because India alone cannot decide this. So, it must be a group collaboration. That is, there must be a collaboration between countries. So if India and USA have to make sure that profits are not shifted from India to US, both have to come together. Not just India alone can decide or USA alone can decide, both have to come together. So there is a requirement for international collaboration to see that this base is not getting eroded, profits are not shifted, so that though most of the transactions are actually happening on a global level, it is made sure that the profits are actually not shifted. So the OECD, that is Organization for Economics and Cooperation Development, they came out with several plans, draft plans over the period. So they started this activity from 2013 and finally they issued a draft plan in October 2015. So the first version actually came out in this period. So when you talk about this BEPS, probably the essence of BEPS can be divided into three concepts. That is, they are trying to address this concept of scorance, substance and transparency. So they have divided as projects. So each action plan, so each of the projects of this BEPS is called as action plan. So there are several action plan which addresses one of these, that is either the coherence or substance or transparency. What do you mean by coherence? The first one. So basically, the coherence will provide you a guideline whereby they say that create a situation of this tax withholding. So when one country automatically provides a scenario where tax is withheld, for example, we are talking about India transacting with USA, right? So when India has to transact with USA, let's say USA has to let's say USA has provided services to an Indian entity for which India is supposed to make payment. Now in this payment, the regular TDS concept, instead of paying 100 to USA, if the Indian entity is paying 90 to USA and paying 10 to the government as tax deduction and reporting in the name of this US entity, what happens? Even though if US entity is not reporting in India, even though if they are not filing the return of income, it is automatically ensured that income gets reported and TDS gets deducted. So it is an automatic thing. So by making sure that withholding is happening, there is an automatic way in which this profits does not get shifted, because a base profit is already withheld in the country in which you are expecting some tax contribution. So these becomes a prerequisites on an international level. If each of these countries decide to create that, these are the set of guidelines whereby we put in place to see that an income is recognized and a tax is withheld in one location, so that automatically what happens, there is no concept of double non-taxation. So at one place it is definitely taxed and India gets its due share of TDS, and it lets the US go whether it files its return or do not files its return. So that is the concept of coherent. Action plan 2 to 4, action plan 2 to 4, that is 2, 3 and 4, discuss about such concepts which will encourage recognizing income in a particular location and see that there are international guidelines to follow this. So that certain things becomes a prerequisites to bring this concept. The next one, that is action 5 to action 10, discuss about substance. That is basically, when you say substance, it is a form of the transactions, substance over the form and all those things. So you take the base transaction basis, whatever the transaction has actually happened, you consider that. So whatever is the current laws in the domestic laws or whatever international laws, it has to be modified to see that substance is given importance over form. We have already seen this in several cases in income tax itself. It's basically substance over form. So form is the entity which is basically seen as some registered entity, something which is seen in your eyes, a person which is visible to your eyes, or an entity which is actually registered. But when you say substance over form, the real owner, the beneficial owner could be someone else. So modify the present tax laws to suit this concept of substance over form. So whatever happens, when you talk about this recognition of this income and taxes, we see that both income and economic activity is given importance. So income is probably a result of some business activity. So you also consider that an economic activity must also be included as part of the recognizing a particular transaction and its value. So that is about substance. And finally, areas relating to transfer pricing. That is, when you say transfer pricing, that's where the substance over form probably plays a huge part. So you try to act as one entity here, but you will actually be represented by one another entity, which will be the controlling entity. They will have some form of let's say either the management or the control or the capital, some form of influence on these three. So such entity will be taking care of the whole perspective, whereas the actual person which is seen in the eyes will be this Indian entity. So this will result in between group entities transactions where prices are influenced, transactions are influenced. So there this area of transfer pricing should be given importance. So that is substance. And next is transparency. This article 5 and 11 to 14 provides topics about transparency. So it says that what has to be there in the what you call the international transaction. So it says there must be guidelines to provide greater transparency, and whatever their actual arrangements are, relating to the tax must actually be disclosed. So you disclose whatever is your tax planning structure, all those things to a particular government entity, so that it is known on how you are actually making transactions and how are you structured with respect to taxes and others. And finally, whenever there are disputes between entities which are located in different countries, we should see that there is some mechanism which will help them to sort out the dispute. So that is about transparency. So these 4 articles, in fact 5 articles, it is 5 and 11 to 14, talks about this concept of transparency. So what does this achieve? All we said, there is congruence, some actions are given importance to substance and some on transparency. What do they result? What do they provide? Finally, what is the outcome because of such action plan? We said the final objective is profit should not be shifted, basis should not be eroded. So this is the primary objective. So if you actually look at this outcomes, there is concept called minimum standards. That is, when you say minimum standards, what are the minimum requirements that a particular entity which is falling under this concept of this multinational enterprises, that is globalization, what are the minimum requirements that they should follow? So while discussing about these action plan 5, 6, 13 and 14, we will be talking about the minimum requirements. And then you have reinforced international standards, which is like there are existing guidelines, you are completely rephrasing it into a new set of guidelines to help providing a better guideline with respect to certain transactions such as transfer pricing or similar transactions. You provide a upgraded, that is amended guideline to help these global transactions. And finally, it will also help you in structuring, that will also help you in guiding on giving a common approach and best practices, that is whatever has to be globally followed. You don't say in India you need to follow this, in USA you need to follow this, in Australia you need to follow this. So you give some common approaches and the best practices which must be followed to see to that bases are not eroded, profits are not shifted. All these guidelines are actually given to this the specific countries. It's a global guideline which can be adopted in the domestic tax laws by the particular country. For example, we said these are international guidelines. If required, the Indian government can implement some of these action plans in some form or other into the Income Tax Act or the read with the income tax rules. So this is what we are calling as that the requirement of this BEPS. So BEPS is basically guiding the governments and the enterprises in turn to have a effective transactions on a global level. So we will see all the action plans in one shot. So basically the first one is new challenges. So basically if you actually look at it, because of this globalization, the entire platform of how business is done, and that too we all know how businesses are done over these last 2 years, that too in COVID we all see that it is everything is digital, right? So how do you address this digital economy? You sit here and at click of a button you buy something. When you buy something, you do not know where that website is located, from where are you actually accessing that website. Is it from India or somewhere else? Where is that company actually located? Is it an Indian company or not a company? By click of a button, you are able to purchase goods even from Amazon, the US website, UK website. So you are able to do anything by sitting in India, right? So what has to be addressed? tax issues related to digital economy is discussed in this new challenges, that is action plan 1. Action plan 2 talks about hybrid mismatch arrangement. We will be talking about scenarios where there is a mismatch between, let's say there is a scenario where you escape taxation completely from the perspective of treaty and from the perspective of local domestic law, so you end up paying no taxes at all. So when there is a mismatch between treaty and where you misuse certain things to gain the what you call the undue benefit by misusing certain provisions or by interpreting in a manner whereby taxes are getting evaded, or there are certain things which will be discussing in hybrid. So it is typically there is in both the scenarios, that is your international level and the local tax laws, it is escaping, you're misusing or you're escaping something. So how do you avoid such mismatch arrangements? So we'll be talking about mismatch arrangements in the action plan 2. And the third is CFC, that is your controlled foreign corporations. That is nothing like your TP rules, that is your what you call the AE, associated enterprises. So CFC is about controlled foreign corporation. So how do you design an effective guidelines for such enterprises? So CFC rules, what has to be there in your local laws or in the treaties. So that's what is discussed in CFC. And then fourth one is interest. If you actually see, if you invest as share capital, you can only take it out as a profit. So what happens? You will have to wait till profits are being earned and profits are actually distributed. So unless profits are distributed for a company, they will not be able to enjoy the profit, right? So if there is company, let's take there is a company called ABC Private Limited, which is held by A Inc. in US. Now, if A Private Limited has made 1 crore profits, can A Inc. just say, give me that 1 crore? Can they do that? No. So this has to be distributed as an income, as a dividend or something to A Inc. Only then A will probably get the share of money. So what happens in that case? A Inc. has to report an income. So dividend is a taxable income. So A Inc. has to pay additional tax. So it will result in additional tax, which is a burden. So what happens in such cases? You do not prefer taking it out as a dividend. So as an alternate, you take it out as an interest. So you say that you have given a loan, so monthly you take interest, whereby you say it is all interest. So there is no question of distribution. So it is not, there is no question of this additional tax and all. So that is what is there. So there is a restriction on what kind of, like what is the quantum of interest basically you can charge a group entity. So this interest is about what is the level in which you can charge an interest, because more the interest are charged, your profits doesn't accrue here, your base in that base country gets eroded. So there is a possibility of restricting interest. So that's what we'll discuss in action plan 4. And 5 is about what about countering harmful tax practices. What do you follow to see that the tax practices, there is a guideline to see that the harmful tax practices are avoided or not allowed to happen with respect to the international transactions. And how do you avoid treaty abuse? So what are the guidelines that can be in place to restrict this treaty abuses? So that's the 6th action plan. And the 7th one is about permanent establishment. So basically, what are the types of permanent establishments? How can you actually avoid various situations where the income is not attributable to a particular location, which becomes a permanent establishment. So that's what you're calling as action plan 7, which is about permanent establishments. And next one is action plan 8 to 10. It discusses about transfer pricing. So what are the guidelines for transfer pricing? So with respect to transfer pricing outcomes and its value creation. And the 11th one is data analytics. So how do you measure and monitor this concept of BEPS? So that is discussed in 11. 12 is what are the things that needs to be disclosed, mandatory disclosure that has to happen. And with respect to 30, what are the documents, what are the information that has to be prepared and submitted or prepared and kept by a particular entity with respect to these international outcomes. So that is 13. 14 is dispute resolution. We said whenever there are dispute between countries, what can happen, what do you do? So how do you actually sort out such disputes? So that is discussed in dispute resolution. Finally, what about this multilateral? So multilateral is multiple country. When you say bilateral, it is two countries. If India and USA have entered into an agreement, it is a bilateral agreement. If there are more than two countries involved, it becomes a multilateral. So how do you see to that there are certain multilateral convention? So rather than having only treaty between two countries, that is India and USA, what if you have a treaty between multiple countries? So in that case, what can happen if required? Probably there could be multilateral convention to see to that prevention of BEPS. So that is, you make sure that bases are not eroded and profits are not shifted. So these are the 15 action plans. We are going to see each one in just briefly. So as I told you, I will not be going into the details of each of the action plan. I will just broadly tell you what it is, what are they trying to do it with this BEPS. So first one is action plan 1, that is digital economy. What is the issue in digital economy? So in these days we see that there is no link between the physical location and the income generation location. We were talking about Amazon itself, right? Or probably any marketplace, e-commerce marketplace. We are going into that website when you are ordering a product. The product that we are ordering, we do not know where that particular product is located or whatever, or from where is that income being generated to that location. So there is a link that is dissolved, that is, it is no more in place between the income and the physical location. The activity that generates the income and the physical location need not be the same place. It could be completely different. So there is no link between this income producing activity and the physical location. So how do you determine the taxation? So do you tax it in the location where it is produced, where that activity is actually happening, or in the physical location place, or in the place where it is physically located? Which place do you prefer? So how do you characterize them? How do you locate them? Let's say you are accessing a particular website which is generating revenue through Indian customers. If that website that we are accessing is not in India at all, it is based out of a particular location outside India, no one will know whether income is actually attributed to India or not, because we are not sure about the location itself. Probably the locations could keep changing also. This week in Singapore, next week in Dubai, it could also be this. So how do you actually locate the transaction? How do you locate the taxpayer? So how do you locate them? How do you know that they are located in Singapore? This transaction has happened in Dubai. How do you know that? So this is a issue. So this is also an issue. So when we said the first issue of being related to digital transaction is the link between income and physical location is no more in place. And when it comes to taxation, it becomes difficult to characterize. Is it a product or a service? What kind of service? How do you locate the place of transaction or a taxpayer? So OECD wanted to modify the existing rule of permanent establishment. So generally permanent establishment is a fixed place, right? So PE is basically a fixed place, but now there is no concept of fixed place, right? Because we said it might keep changing also. We may not be able to actually locate the transaction or the taxpayer. So the issue gives a situation where there could be this concept of virtual PE, that is your virtual permanent establishment. What do you mean by virtual PE? Because you don't have a physical location, it is virtual. So there is a definition that is being put in place for this virtual permanent establishment. One of the example of this kind of virtual permanent establishment is server. So when you say virtual PE, one of the example is server. So when you say server, server could be located anywhere. So the company is in one particular location, the server is in one location. Whatever income generation activity is happening will be happening through that particular location, where server is situated, So it becomes important that we bring in a concept called virtual PE. And then you have imposition of final withholding. That is, as we said in this coherence, we said it is advisable that tax is deducted in the place where transaction is happening. We also spoke about, there is also concept of equalization levy that has been brought into place to avoid this. So OECD recommends either provide rules for withholding taxes or provide rules for equalization levy. So only then you can control this tax evasion or profit shifting because of this virtual permanent establishment. And very recently, there has been this concept called Pillar 1, Pillar 2, where basically they say Pillar 1 is reallocation of profit. Fine, you might be transacting in many countries, but see to that some part of profit is already reallocated. So though you are not recognizing any profit in India, do it in a manner. So there are methodology given to reallocate some profit back to India based on the activities happening in India. So this reallocation is Pillar 1. And global anti-base erosion mechanism. So what do you mean by that? You create a fixed percentage. So if you say, if certain transactions are happening in India, you pay tax in India and go. You, whatever happens, there is a fixed percentage of tax that has to be remitted in India, and only then transactions could proceed. So this becomes like a support activity which will help you in global anti-base erosion mechanism. So it's something like your globe. So global anti-base erosion mechanism. So you can, so this global, on the global level, you are arriving at the anti-base erosion mechanism. So what has India done to this digital economy? They have brought in this concept of equalization levy. We will not talk about this right now because the next session is going to be on equalization levy. So we will discuss more about equalization levy in that particular session. And however, if you actually see, India further in Income Tax Act has introduced this concept of significant economic presence in addition to your the business connection we spoke about. So it is restricted to certain transactions such as your specifically relating to software, that is download of data or software where exceed aggregates payment as prescribed. That is, whenever there are advertisement services in a particular location, this online advertising services and other things relating to this download of data or software, if it exceeds 1 crore or something, it results in a situation where the significant economic presence will automatically get attracted. And then you have a marketing activity that is related to systematic and continuous soliciting. So where it is relating to a marketing activity, when there are support relating to marketing activity happening in India, so irrespective of where the business is happening, some profit should be attributable to India also. So that is about systematic and continuous soliciting. We have seen this already in section 9, and these significant economic presence will be considered as a presence in India irrespective of whether an agreement is entered in India or whether there is a place of business in India or whether services are rendered in India, which means in short nothing is relevant, nothing has to happen in India, the person need not be in India, the agreement need not be in India, the activity need not be in India, it could still be considered as a significant economic presence in India. So this is another step which is taken by India to address this digital economy, which has been suggested in Action Plan 1. Moving on to Action Plan 2. Action Plan 2 is basically addresses a situation where, let's say, there are different tax treatment which exploits a difference in tax treatment. The particular entity tries to exploit, tries to see which is beneficial in tax treatment of an entity or an instrument. So it could be an entity or an instrument, whereby what are they doing is they are considering 2 or more locations and seeing which tax law is more beneficial to them. So the result, the final output is double non-taxation. So to achieve double non-taxation, what are they actually saying is, they are trying to say that the income, if it's happening, let's say in India and the base country is in USA, it is not taxed in India also, it is not taxed in USA also. So we said it basically this treaty supports in avoidance of double taxation. If you actually see, there are also situations which could result in double non-taxation, which means it will not be taxed in both the locations we are talking about. So to achieve this, what they could exploit, the particular entity could exploit the difference in tax treatment based on the treaty agreement or whatever, to see that they compare this 2 or more tax jurisdiction and see that they achieve double non-taxation. So this is a mismatch. mismatch in agreements, right? So there is a clause in agreement which is helping you achieve this. So this must be addressed. So like something like your treaty shopping or something. So what happens? What does this hybrid mismatch of arrangement results in? So it might result in a scenario where there is creation of two deductions for single borrowing. There is a deduction claimed in two different locations for the same particular transaction. Or there should be generation of deduction, that is you are claiming deduction but you are not claiming the corresponding income, which means it is again wrong, right? Because when you have to deduct, when you have to claim expenditure, you will have to claim expenditure which is attributable to the income, which is wholly or partly attributable to income. What if you are allowed a deduction but the corresponding income is not included? And there could be a scenario where foreign tax credit is misused. We saw in section 90 whereby they spoke about the concept of tax residency certificate just because there is misuse of foreign tax credit. You may not actually be a resident of that country, but by some means you will claim to be a resident, you will claim this foreign tax credit. So the tax residency is different. Generally you registering as a company in a particular country is different. I may be a company registered under Companies Act 1956, I become an Indian company. Sometimes there is a situation, I am actually a company registered in USA, but I am still treated as a foreign company here in India and I am liable to pay taxes here in India for the incomes earned. So what happens, I might misuse, actually I might be a resident in India for that particular year, but I might present myself as a resident of some other country and claim that foreign tax credit. So there was a misuse. So that's where India brought this concept of tax residency certificate. And similarly, exemption regime. So we said there is a situation where if there is resulting in double taxation, one country might give this exemption where the other country alone will tax. This will be taken with due care so that it does not result in double non-taxation. So it provides that it does not result in double non-taxation. So the BEPS Action Plan 2 recommends certain things in the domestic law. The first thing is denying transparency. So what they are saying is certain countries, for example, let's take US, where partnership firm is a transparent entity in US, which means firm is not taxable, only the partners are taxable. So what this suggests is rule denying transparency to entities where the non-resident investors resident country treat the entity as opaque. So you deny transparency, let's say according to India, the partnership firm is considered as opaque, right? So in such case, US should not consider such partnership firm as transparency because the source country is actually recognizing it as opaque. So this is the reason they are saying that deny the transparency where in that particular country it is not transparent, it is an opaque entity. So an example is firm in India. So in India, firm is opaque. So when some other country where firm is a transparency, they need to deny transparency for such entity which is treated as opaque. So for that firm here in India should also be treated as opaque in US also. So that's one of the recommendations, so that no one tries to misuse the provisions, right? So that's the point. And denying an exemption. The next denial is exemption or credit. So the foreign tax credit or the exemption provisions should be given due care before actually allowing it. So rule denying an exemption or credit of foreign tax for dividends that are deductible by the taxpayer. So it must be given care. Similarly, denying foreign tax credit. So basically when withholding tax credit is already happening, we should see that the one which is actually taking care of, that is a rule denying this foreign tax credit, whichever country that we are talking about, the rule denying foreign tax credit, the country which is actually must deny the foreign tax credit, where withholding tax is actually credited to some other entity. It is not actually credited to the same entity which is providing the foreign tax credit. So we should see that the credit should be, the foreign tax credit should be given to the same entity and not to a different entity which is actually using the withholding credit. And finally, this amendment to CFC and other things. So amendments to CFC and other similar regimes. So this is one thing. So we saw control foreign corporations, which is something like your AEs. So we must take care that amendments in the domestic law is made to this relevant provisions of controlled foreign corporations, AE or related parties, to see that the misuse is not actually happening for this hybrid mismatch. So what are the issues considered here? So when you talk about this tax treaty issues, it is basically, it must be dealt in such a way as we are speaking about transparent entity, because there is a situation where in one location, something like firm, let's say in US they are transparent, in India they are opaque. So there could be a situation that it is actually taxable in India, but since they are a non-resident, it should only be taxed in USA. But in USA, they are a transparent entity, so it is actually not taxed in USA also. So they escape. So such transparent entities should be given importance to and create anti-hybrid rules. So see to that the treaty shopping is not happening. The benefit of analyzing the entity and taking the undue benefit in one particular treaty or something is not happening. So in short, this hybrid mismatch arrangement is basically where you avoid misuse of provisions which is beneficial to the assessee, thereby resulting in no taxation in both the locations, double deduction in both the locations. To avoid this, we must put in place certain rules. That is what we discussed in the last couple of slides. So moving on, we will move on to the action 3, which is your control foreign corporations, whereby OECD says there is a result where income gets shifted from a high tax jurisdiction to low tax jurisdiction. One entity considers to keep profit always in one particular location, in an offshore location where probably there is no tax or something, and they differ in such a way. If you bring back the money to home country, you might have to pay tax. We said about dividend, if profit is distributed to the holding entity in USA, they will have to pay tax in USA, so they differ home country taxation. Control foreign corporation rules. So there must be set of rules for this group entities to restrict such transactions. So it encourages, OECD encourages about clear-cut definitions of called as building blocks, whereby certain definitions of CFC is given, exemptions and threshold requirement of various transactions. How do you consider or compute the group incomes? How do you consider it? The rules related to it. How do you attribute taxable income to one particular location? When do you provide exemption or credit mechanism? So you give a detailed guideline as to when, how is an income taxed in a particular location when it comes to this CFC. So that's about CFC. So what has India done? India does not have any specific CFC rules apart from transfer pricing. So transfer pricing actually does not fall into this. It is only about transactions between two group entities or whatever. This controlled foreign corporation is more of profit shifting, is only about profit shifting. So transfer pricing is a general transaction. So we proposed this in direct tax code, but of course direct tax code is doesn't look like it's going to come out. So it is still there in the draft stage itself. But in the meantime, there was this section 115 BBD where certain foreign corporations which holds a considerable shareholding, that is more than 26%, 26 or more percentage, there is a special rate for dividend distribution. So they allowed countries, the host countries, that is the countries in which the holding entity is there, they requested them, or probably they allowed them to repatriate funds, distribute profits from India to that country, so that it is they are actually taxed at a very low rate, so that they encourage them to take the profits and reinvest back into India. So there might be encourage repatriation. So bringing back money into India, there were this provision which helped them to distribute dividend. So that was the thing. So action 4, next one is action 4. It is about interest deduction. We said about the concept of interest, rather than getting as share capital and making profits and paying taxes while distributing, you end up providing as a loan. So you locate third party debt in high tax countries. So you find out whichever country which has high tax, you locate a debtor there and take money. So you locate a third party debt in high tax country. You use intra-group loans to claim interest deductions. So as we said, you shift profits in the name of interest. So that's the point here. As I told you, I am not going to go into the in-depth parts of these action plan. Just understand the crux of the action plan alone, and using related party to finance the production of exempt or deferred income. So that's also another thing. So OECD provides fixed ratio rule. What is the fixed ratio and group ratio rule? So there could be fixed ratio between two countries or overall group ratio in case of loan lending and other things. Whereas India has introduced section 94B. We have already discussed this, whereby interest paid in excess of 30% of earnings before interest, tax and depreciation will be disallowed. So this is for entities where the interest payments are more than 1 crore. And the next action plan is action 5, which talks about counter harmful. So basically they select situations which will affect the transaction. So they identify factors that are affecting that gives preference to this tax regimes, so which will result in low or no tax. So they identify such tax regime, the countries which will give them that benefit. So they identify that and create such informations to restrict them. So they identify countries which will probably result in low or no tax. If it speak about India, India will find out countries where there are low or no tax, and such countries will be called as tax havens or no tax jurisdiction. So in such countries, India will have additional informations to gather various information or collect various information to see that there are no misuse of tax provisions, treaty provisions. So that is counter harmful practices. So further, apart from this, to support this counter harmful practices, the judicial rulings and all those things, various judicial rulings across the globe will help in addressing this counter harmful practices. So it will set a guideline what is called as harmful practices and what should be done to counter harmful practices. So various tax regimes and judicial proceedings will support the country. So in India also has with respect to this 115 BBF, where they have a restricted income tax rate for 10%, so that we feel that money will be brought into India. So that's to encourage such, so that taxes are not eroded in another country. So we bring in the money through this 115 BBF. So counter harmful practices to create scenarios whereby they encourage you to trade and pay tax in particular location. Our action 6 is preventing treaty abuse. So similar to your hybrid mismatch. So similarly here it is only about one treaty. So you take the treaty, you find what actually could be misused, you utilize that and claim the benefits. So avoid this. They provide clauses like limitation of benefits, whereby they say even if you are allowed benefit, it is restricted to this. And you can claim such benefits only if you are proving certain things. So there could be conditions or restrictions to limit you in this treaty shopping. So that is what is there. And you also look into probably what you can call a simple word like fake transactions. You create a transactions just for the sake of money tripping or just misusing the provisions of treaty. That could also be restricted. So to avoid treaty shopping, BEPS provides for this. Where they avoid treaty shopping, they bring in provisions such as your this limitation of benefits and the conduit agreements, that is financing arrangements for various entity. So when you talk about this action 6, what has India done to this? In Indian Mauritius thing, there is this gain from alienation of shares acquired on. So they have brought in this concept of limitation of benefits by saying that benefit of 50% will not be entitled. We are not going to go into this particular thing. Basically, India has specific provisions of this LOB clause, that is limitation of benefit clause in Mauritius and Singapore DTAs to restrict some part of income there. So that's what it is. So the next action plan is prevent the artificial avoidance of PE status. So we said PE definition is changed to bring in wider definitions of PE. So it results in a matter whereby the enterprise will be considered having a taxable presence through virtual PE itself. So that's what we said. So preparation or auxiliary nature is not a PE. So basically we said virtual PE and other things are considered. At the same time we also said liaison office is not actually a permanent establishment. So such things is what is recommended through BEPS in action plan 7. So what are they doing is, they said bring in PE exceptions. Just because a permanent establishment is shown, don't tax everyone. It could be a scenario where it is something like a liaison office. So to create that, create a clear-cut PE definition including the exceptions. Tell them what is not considered as a PE. Also bring in that. And analyzing arrangements entered through contractual arrangements and commission arrangements. So what do you deal when there are contractual or commissioner arrangements between one party and another party? How do you deal with such agreement? So it's like principal agent, where agent will be considered as a permanent establishment. And action plan 8 to 10 is about transfer pricing. 8 discusses about intangibles. 9 about the returns that another country has to probably be eligible to be rewarded, the return that must be rewarded to the other country. And 10 is about the high risk area. So 8 talks about, as far as intangible is considered, what happens in case of between the control transactions. They address the problem about difficulty in valuing this intangible, what could be considered to arrive at this valuation of these intangibles. And similarly, how there could be a scenario where profits are not properly allocated because value addition could have been provided by one country, they would not have been rewarded for such value addition in intangibles. How do you address that? So these are the issues that are addressed. There is control transaction, difficult to value, and misallocation of profit. So these are addressed in intangible. When it comes to returns, what happens in contractual allocations, that is when our contract agreements and other things, how do you treat it? And as far as these level of returns, how do you actually do? That is interest versus profit. Are you actually claiming it as an interest or as a profit oriented activity? So that's what is discussed in funding or activity in this level of returns. And then in a high risk area, profit allocation is discussed. How do you actually methodology to determine profit allocations, and the TP methods we discussed, that is your cost plus method, your resale price method, your comparable uncontrolled price method, your transaction net margin method, your profit split method. So all these 5 methods are discussed in TP methods. And what are the type of payments that can happen between this associated enterprises in transfer pricing transactions. So this gives the risk and the outcome, and possibly how to address such transactions relating to intangible, the returns, and the high risk areas. So that is what is an action plan 8 to 10. And action 11 talks about measuring and monitoring BEPS. So basically, when we said measuring and monitoring BEPS, we know that this BEPS is basically requires various disclosure. So how do you actually keep track of whether profits are shifted, whether bases are eroded? So they say that see that profit rates in M&A affiliates, that is a group entity located in lower tax, is higher than their group average. So this is one of the conditions that could be given. So whatever profit you are earning should be higher than the group average is what they are saying. And what are the effective tax rates of the overall group? You compare that with the similar enterprise with domestic operations. So it's like a group comparison with an industry comparison. And what is the government for the country as a whole to understand the economy and to measure and monitor this BEPS? They'll try to understand what is the ratio of FDI to GDP. If it is more than 200%, something has to be addressed. So they need to see whether FDI is increasingly getting concentrated in particular location itself. So these are the steps that the government can take to ensure that BEPS is actually not happening, that is base is not getting eroded and profits are actually not shifted. So and similarly about taxable profits from value creating activity. So what is the proportion of royalty to the expenditure spent on R&D? So that ratio, how do you see that? Royalties received by low tax countries accounted for 3% of total royalty. So they have set a benchmark whereby they say royalty received by the low tax countries, that is higher tax jurisdictions paying to lower tax jurisdiction, is very low in number, because in such cases there is no requirement for shifting the profits itself. So these are all the things that is addressed: the interest to income, royalty to your R&D, your FDI to GDP. All this could be considered by the government to understand whether this BEPS is actually taking place, whether there is impact of BEPS happening in a particular location, whether the economy is disturbed because of such transactions. It could be achieved, it could be understood through these what we discussed in this particular slide. So that is about action plan 11. Action plan 12 is how do you actually what plans can you take for aggressive tax planning arrangements? So what should the government do? So they should see that there is timely access to information. There is probably a framework, proper framework for guidance to see that what exactly is allowed and what is not allowed. And whenever the information that you receive, the timely access information, is well in advance, it could be used for potentially aggressive or abusive tax planning. So we should see that moment an agreement is entered, a government should understand whether it is abusive or potentially aggressive. So something like your GAR and all is to address this. So immediately once an agreement is entered, we see that whether it is for the purpose of tax evasion or aggressive tax planning, and we should create situations for effective information exchange, and we should create scenarios where they must mandatorily disclose certain things. So government should frame rules to address these informations in such a manner that tax could not be shifted and profits could not, bases could not be eroded. So, and we must have good relationship between the tax administration of other countries, so that we are able to recover information or whatever is required for us for this action 12. So we must provide what must be rules that could be created to address this aggressive tax planning arrangement. So India as kind of GAR is provided by India to address this particular action plan 12. And action plan 13 we have already discussed in transfer pricing. So it is divided into a 3-tier structure, which is your master file, local file, and country by country reporting. We are not going to see about that because we have already discussed in detail in the transfer pricing provisions. And the last two, action 14 is about making dispute resolution more effective. So when we said whenever there are issues, you create a situation where minimize the risk of uncertainty. So you see that the treaties or whatever guidelines you are providing will minimize the risk of uncertainty and will minimize the unintended double taxation. So your intention should be that transaction should not be double taxed. So you create a scenario where you are actually not letting it happen, but you probably cannot avoid it completely. There might be a situation here and there, but it should not be intentional. That is, minimize unintended double taxation. And what measures can be taken for that? Proper implementation of taxes, timely resolutions of disputes. So when disputes are worked out in a short span of time, probably the issue doesn't get prolonged and costs could be saved both from the government and the entity side. So what are the procedures that India has implemented? Something like your MAP, mutual agreement procedure, advanced pricing arrangement, safe harbor rules. So all these are implemented by India to address these dispute resolution. So by doing this, they are avoiding disputes, they are avoiding litigations, they are letting entities have transactions without facing issues, litigative issues. So that's what this MAP, APA and safe harbor rules support in India. So similarly, this BEPS Action 14 is recommending such dispute resolution plans or application through MAP or whatever in the particular local law. So whatever we have been seeing is a guidance or an information which is helping them, which is guiding the government to introduce them in the local laws in one way or other. So and then action plan 15, developing a multilateral instrument. So we said whenever it is required, there could be a multilateral instrument for what? Preventing treaty abuse, improve dispute resolution, neutralize effect mismatch arrangement. So generally there are bilateral, but BEPS Action 15 is encouraging even multilateral. They might provide a multilateral instrument for preventing treaty abuse, the dispute resolution and the hybrid mismatchment. So what is MLI? That is your multilateral instrument. It's basically it's an instrument that are covered tax agreements. So this covered tax agreements or the intention of this covered tax agreements are for double taxation. So when this countries, this multilateral instrument, the treaty of that some kind is entered between country on the multiple levels. So there could be various agreement with the same country to see that double taxations are avoided. So these also encouraged by, recommended by the action plan 15 of BEPS. So these are the 15 action plans of BEPS and these are the address. So as we said, for the exam purpose, just understand the concept of base erosion profit shifting and that there are various action plan introduced. Only if you have this elective paper of international taxation, probably go through these slides and understand in specific about each action plan. In that too, you only need to understand the basics. Don't go into the deeper side of this action plan. Just understand the basis, the overall understanding of what the action plan is intending to do. So that's what we need to understand. So with this, this is what action 15 is about and all about your BEPS is about. So as we said, With this, we wind up this base erosion profit shifting session, and we'll see you in the next session. Thank you.